Okay, let's get into support and resistance. The prices move because of supply and demand. And I'm sorry, I'm kind of biting into our third hour here. I'm really going to try to stop right at the top of the next hour. What is that, 3 o'clock Eastern time? I'm really going to shoot for that because you guys are taking a chunk out of your day to watch this. I love doing it, and I could do it every day, all day, but not everybody feels that way. But when you have the forces of supply and demand, and think of that's how the stock market works. When you have a lot of people that want to buy, that's demand, and price is going to go up. When you have a lot of people that want to sell, that's supply, and that's going to push prices down. And so when demand is greater than supply, prices go up. And when supply is greater than demand, prices fall. All right. Sometimes prices will go sideways because we're kind of in an equilibrium or an uncertain point, or we're in a low volume stage like we were for a lot of the month of August, or we're between Christmas and New Year's where people are doing other things at that time. And so we have to ask ourselves, why does this price go up to a certain point and stop and go back in the other direction? Okay, or why does it, when it's coming down and it hits bottom and it turns and starts to go back up? Are there things that we can look at to try to figure out why that's happening at that certain time and at that certain place? Yes. And that's why we study support and resistance. Sometimes this can be explained. Now, I wish support and resistance, I could just say, like the Pythagorean theorem, a squared plus b squared always equals c squared. I wish I could do it that way, but it might be b squared plus x squared equals z half of the time. We pick out these support and resistance levels, but we can know them ahead of time. That's the cool thing, but we're not sure if they're going to be important or not. Back when we were screaming up in 2022, way back here, I have to go back through this. You remember when I said we hit the 200-day moving average? We saw that ahead of time. We knew that was already there. And so we could plan for that before it even happened. But about the time we bank everything on that is the time we're just going to blow through that 200-day moving average and keep going up. So what was acted as support or resistance one time may not act as support or resistance another time. And it may not even be within the S&P. It may be something happening in the NASDAQ or the NASDAQ 100 or the Dow. It may be interest rates going up or down. Okay. And it may not be a high or a low. It may not be hitting a moving average. It might be a fib level. It might be a monthly pivot point or a daily pivot point. So there's lots of different things that we have to watch all at the same time. And I wish I could tell you this is what you need to watch, because about the time I say that, it switches over to something else. So just like most aspects of the stock market, support and resistance, it's not complicated. You're going to go up to a certain level. It's like bouncing a ball. You hit it on the floor, that's resistance, and it's going to bounce up to a certain level, stop, and then start to come back down. That's not all that hard to understand. But it doesn't mean that it's simple. It doesn't mean that it's easy to implement. So it's just like the stock market may not be all that complicated, but that doesn't mean it's a real easy thing to do. It looks easy when you look at a chart, or if you have somebody tell you all this gobs of money that you're going to make. But when it comes right down to it, this is one of the most difficult things to conquer that there is, because there's so many variables out there. And think of who's our competition. We're dealing with people that have unlimited funds, with some of the smartest people on the planet that have unlimited time on their side because they don't have a lot of the risks that we have. That's our competition. So I reverse that and I say, instead of working against them, let's figure out what they're doing and do the same thing at the same time. Just ride on their backs and just ride that wave. And then when they start getting off the wave, we see that, we get off too. All right. Anyway. Okay. So I use specific methods to determine support and resistance levels. And I really try hard to point these out in the video every day. This may act as support. This may act as resistance. I can't say that with any definite dogmatic opinion because I don't know. About the time I say that, it's going to become useless and you guys are going to go, this guy doesn't know what he's talking about. All right. Within the S&P, this can be the previous high or low. And we've seen that happen. And I have some charts. And I have some charts from Friday's session that I used over the weekend to kind of bring this home a little bit more. And I really try to hit this hard in the videos. It may be a trend line. Now, one thing that you'll notice about what I do, I haven't mentioned either in the daily or weekly videos or the intermarket analysis. There's these chart formation, chart patterns, like a cup and handle, and even head and shoulders tops and bottoms. I don't really rely on those that much. Maybe a head and shoulders top or bottom, because that's pretty reliable. But some of these, ascending triangles and pennants and things. Now, there's other people that make this stuff work. I've seen it fail as much as I've seen it succeed. So I don't use those types of things all that much. Doesn't mean that I'm right and other people are wrong. It's just what I've incorporated into my analysis. But I do use previous highs and lows and trend lines. Now, another thing to be aware of with trend lines, you can draw whatever trend line you want. And I watch some of these other videos and I read some books, and they're drawing all these lines all over, especially on Twitter for some reason, or X now. And it's like, where did that line come from? Because that's breaking all the rules. That there are rules for drawing a trend line, and they're going against that. But yet, as I say, if you draw enough lines on a chart, you can get it to say whatever you want it to say. And so there's a lot of different ways that you can interpret this and justify your position. But now you're switching over to emotions. You're not using logic anymore. You might be right, but you might be wrong. I would rather base things on what we actually see using more traditional methods of doing things. Moving averages may also act as either support or resistance. And then Fibonacci levels or the quadrant chart, where I have one that I don't think I have it here, but I took the COVID low. Whoops. All right. I went to the COVID low, and then I went to the all-time high that we set in January 2022, and I drew what's called a quadrant line, which you're just taking that whole space and breaking it up into 25% chunks. Each one of them is a quarter. Well, that may be like, well, what good does that do us? But for quite a while in 2023, that was acting as overhead resistance. And when we finally broke above the 75% level, that's when things really started to scream to the upside. So keeping an eye on those things is pretty helpful. Okay, why am I not advancing here? And also a ratio level. I do a lot of ratios where we compare a sector like the tech sector to the S&P, and we see what is outperforming in any particular sector. And I only look, I don't trade in sector ETFs, and I don't do sector options. But I want to know, because when certain things are acting really well in the market, that tends to mean that we're going to go up. When tech and communication and discretionary, those have been the three big areas in 2023 that have been doing quite well. And when those areas are doing well, lo and behold, we see the S&P going up, we see the NASDAQ 100 going up. But when those areas run into trouble, that's when we see those three areas starting to go down, and they tend to bring the indexes down with them. So that's about as far as I take it. I usually don't break off and do different sectors as positions. I just focus on the S&P itself. And then I have an intraday chart, and I go through that in every video. And I have found that a 10-minute chart, whether it's candlesticks or bars, whatever, that I like them both. I have found them to be very reliable. And I almost fell on this by accident. I used to use 60-minute charts and 30-minute charts. And then one day I brought up a 10-minute chart, and I'm like, whoa, these pivot points that we know before the market even opens, we know what they're going to be. You would be surprised at how often those mark a top or a bottom intraday. And we know this. Now, anywhere from maybe 60% to 90% of the daily volume out there, it's not even done by people. It's done by computers. And what they're doing is they're programming these things into a computer that says, when this certain thing happens, buy. When this certain thing happens, sell. These are the algorithms that they figure out. And they're taking all emotion out of it. And that's the benefit of program trading, is that it's just a computer. It doesn't care. It's not happy. It's not sad. It's not hungry. It's not having a bad day. It's just doing what it was told to do. And that's why there's so much interest in this kind of method because you're taking emotion completely out of it. But I have found on an intraday chart the 10-minute pivot levels to be very accurate. Not always. That's why I go through the R1, R2, S1, S2, the daily pivot. And almost every day, those points are significant. And so that's another area, at least on an intraday basis, where we can find support or resistance. And then we also have these for the daily charts. They're calculated, they last for a month. And then we have monthly pivot points too. Those are on the weekly charts. It's kind of, you go one step forward on some of these charts. And that's where we hit the high in July. It was on a weekly chart looking at monthly pivots, and we topped out. We just hit that right on. And then we started coming down after that. So that ended up being a very significant resistance level. But we don't know that at the time. We have to let it play out a little bit. But when we're dealing with our positions, when we're trying to analyze what to do, we take all of this together. We know ahead of time these things are there. So we know what to watch out for. And if we start hitting those points, and if you're long and we hit that resistance point like we did in July, and we start coming down, you're out. And you've locked in almost at the high. Now, you may let it drop down a little bit because you're never quite sure. And then 1 month on the weekly chart, that ended up being really significant. The next time we hit a level like that, the market may not even pay attention to it. And that's what makes support and resistance more challenging. Because again, we don't really know what's important and what's not important. So we have to watch everything. I actually played with the idea of putting together a spreadsheet every day of all the different support and resistance levels. My God, it would be a mile long. And we would be spending all of our time just looking at all these different numbers, and we would lose track of what's really happening in the market. So I decided not to do that. I try to point them out in the daily videos and just kind of keep a mental picture. And so when the market's open, I keep an eye on these things. And then if we start to hit something, then I really focus on that. And I say, okay, we blew through that support level, or we blew through that resistance level. So that's not really into play right now. But okay, we're coming up to another one. We're coming up to a moving average, maybe in the NASDAQ 100. Okay, we're having some trouble there. We're stalling out right now. And that may come over and then feed into what's happening in the S&P. All right. And then support and resistance levels outside of the S&P may be, and I can't see that last word, defined by another index or even a stock. And I just brought that up. Not so much a stock, but you get the big players like the Apple, the Microsoft, Google, Nvidia. You know, we had Nvidia earnings come out, week before last, and they just blew the market away with their earnings report. They gapped higher. They just shot up in the aftermarket. We gapped higher at the open and then spend the rest of the day coming down, and Nvidia was almost unchanged that day. Well, that fed over into the whole market. So some of these stocks can really have an impact. That's another reason why I don't focus on the Dow as much. Those are only 30 stocks. And you could have 29 stocks in the Dow up. But if one comes out with an earnings report like Boeing or Disney or something's really having a bad day, it can drag the whole Dow down with it. And that's why I like the S&P 500, because there's more stocks to choose from. So you're getting more of a representation. Now, in 2023, the mega caps, the Magnificent Seven or whatever they call them, they've been leading the market higher. Does that bother us that are investing in the S&P? Doesn't bother me. I like it. Okay. We just want the S&P to move. We don't really care what direction it's going to go. We just want to know what direction it's going to go in and then jump on and take advantage of that. I don't care if it's 7 stocks or 200 that are really influencing the prices. We just want the thing to move. And if it doesn't move, we have a plan where we can implement some sideways strategies. All right. And then we should also look at bonds and interest rates to keep an eye on them. That's been coming back into play. We're starting to break out with some, even though we have all these inverted yield curves, some interest rates are starting to break out above levels that we've seen for the last 40 years. And we might be coming into a period of time now where we're going back to what it was back in the 60s and 70s as far as interest rates. We don't know that yet, but it's kind of playing out that way, where this gradual downward movement of interest rates, that might be over. We could come back, but it might also be gone at the same time. And as interest rates start to go up, when they really start to scream to the upside, that'll often freak out the market. In Friday's session, I brought this up in the video. Oil was starting to really go up. And oil typically going up can go up when the market goes up, but it really started to move up. And it was going up so far, so fast that was starting to spook the markets. And that's why we had kind of we just had a little bit of an up day on Friday. Because it's like, okay, oil's shooting up. There must be a problem somewhere. We don't want to buy any stocks right now. In fact, maybe we want to sell some stocks right now. So we just look for these outliers, these things that happen. For a while, I tried day trading for a while and it almost killed me. I was good at it, and I like the idea of being in cash by the end of the day, but man, I wasn't going to live another 6 months if I was going to keep trying to do that. And I had this thing piped in where it was like listening to a sports broadcast, where instead of a football game or a baseball game, it was coming in from the Chicago, where the futures trade in Chicago. Is that the CME there? Whatever. And these guys that, it would be like, and here we go. Here's, Merrill Lynch is coming in. They're going to buy some futures at the, current market price. And you hear this screaming and yelling and everything going back and forth. Well, one day, the S&P futures just started to tank. And then the guy on this broadcast, he's saying he could see over into the other room, which is where the oil futures trade. And they were going crazy over there. And that was bleeding over into what was happening in the S&P futures market. And it was causing oil to really go up and the S&P futures to go down. And that's just kind of, these are dynamics that happen every day that we don't really know about. And if we do find out about them, it's after they happen. And so that's why I believe in looking at the charts, because we know everything about what's happening based on the current price. And if it's moving up, things are more positive. If it's moving down, things are turning more negative. But we want to key off of these different markets because they can give us clues. That's why I do the intermarket analysis video every week. And I look at aluminum, corn, wheat. I don't care about that stuff. But if it really starts moving one way or the other, that can come through and have an impact on the S&P. All right. And then we keep an eye on the dollar. The market's typically like a weak dollar. Now, officially, according to the U.S. government, according to Al Gore from a long time ago, the U.S. has adopted a strong dollar policy. That's the official stance. But the unofficial stance is we want a weak dollar, because the dollar going down in value, that means when you're doing business with other countries, the exchange rate is going to be more in your favor and you're going to get more dollars, and that looks good on the accounting for that. It also works out from an import-export perspective. And so when the dollar's going down, a lot of times the market will be going up, and then vice versa. One of the reasons we really struggled in 2022 was that the dollar was going up. It had a good year. It broke above 100. It got up to 110 or so and was really screaming. And it's not that there's anything special about the dollar, and compared to the euro, compared to the Japanese yen, it's like, okay, the dollar is like the least crappy thing out there. It's not that the dollar, none of these currencies are backed by anything anymore. We're off the gold standard. But this can also have a real impact. And so since we've been seeing, as the market was going down throughout August, what was the dollar doing? It was going up. So we want to keep an eye on that. And if the dollar really starts to reverse, that can give some support to the market and help stocks go up. And then the inverse of that can also happen. All right. And then we keep an eye on oil, gold, silver, or any commodity. We probably don't watch pork bellies all that close, but I don't even measure that. But, especially gold, silver, the precious metals, oil, the things that really have an influence on our everyday lives as far as a practical use. That's why I do the intermarket analysis video. And I look at these things every day, but they might provide some support or resistance. But where we're really going to get most of our information from is by looking within the stock market itself. But we still want to know about these other things at the same time. Okay, some guidelines that I've gone through. The nice thing about support and resistance is we know about this beforehand. The problem is the list is so long, we don't know what's important and what's not important. And we often can see confirmation when other indexes are hitting support or resistance at the same time. We've been battling that. We're battling that right now with the NASDAQ 100, and the S&P. We have overhead resistance above where we're at, and all of those indexes are hitting that at the same time right now. So if one of them really breaks out, it's probably going to bring the other ones with it. And until we get some real catalyst to push us higher, we're going to have a real hard time breaking through those levels. And that's why we're currently in a trendless environment, because we have low volume. It's the latter part of summer. We're coming up to a 3-day weekend, and people don't want to, risk millions of dollars thinking what's going to happen when there's still all these variables out there. All right. And then the big variable is we're never quite sure which levels are going to be important and which ones aren't, what we can ignore and what we need to pay attention to. And I wish I had a good answer for that. I just don't. So we look at all of them and just know that they're there so that we might need to take advantage of that. This list can become very long. And as I said, I was going to create a long list, but then you're spending your whole time looking at this list and it's like, incidentally, I don't have it in here, but you might not be aware of this. The daily pivot points on the 10-minute intraday chart and the pivot points that last for the whole month based on a daily chart, I post those on the community tab of the YouTube channel every day. That's the first thing I post. So if you're not aware of that and you want to use those levels, because we know them before the market even opens, so they're there for you to use. So feel free to check those out if you feel that'll be helpful. There is a pivot point calculator that is online where you put in the previous open, high, low, close, and that gives you today's pivot points. It's a little bit different than the pivot points that I use with the charts. So be a little leery of that. But sometimes when I have to calculate S4 or even S5, no, there isn't an S5. The software that I use only goes up to S2 and down to R2. I'm sorry, goes up to R2 and down to S2. If we start hitting the 3 levels, that's not automatically plotted on the software, and I have to go to this other software to calculate that, and then I have to draw that line on the chart. So there are ways, and people know this, and these are put into the algorithms that the computer programs are using. All right. So don't try to put the market in a box. Like I said, what worked one time may not work the next time. We can't think that we've got it all figured out now. So don't fall in love with a particular support or resistance level. Just know about it, respect it, know that something might happen, but something might not happen too. And I wish I could be more cut and dry with that. Okay, I try to point out the possible support and resistance levels in each video, and I really try to hit that pretty hard. Here's just a graphic of support and resistance where you're looking at the bottom here, where we're coming up, and then for some reason we stopped right at this point, and we came down here, and then we found some support here. We bounced back up. We came to a high. We stopped and came back down. Because see, at the time this is being created, it's not support or resistance yet. It's being created for the first time. That's one of the issues when we break out to all-time highs with the S&P or the Dow or the NASDAQ. We're in virgin territory at that point. So it's going to be a lot harder for us to find support or resistance if we do go back and break out to the upside. It's not going to be impossible. It just means we kind of have to shift our focus in a little bit different direction. But now, as time goes by, what happened here, we broke above it, and what once was resistance, once we break above it, now becomes support. And then we go up and we set a new resistance level. And then it's just the inverse of that when we're going down. So what I've tried to do here, this is the daily chart, or the intraday chart, and if you watch the videos, you see this every day in the videos that I do. And I'm trying to bring up the clock here. Okay. I've got 18 minutes. All right. Okay. I'm really trying to respect that, the time factor here. Plus, my voice is going to be gone here pretty quick, too. I was teaching all day, and now it's turning into late evening for me, and I've been blah, blah, blah all day. All right. So this is a 10-minute intraday chart. And here's the pivot points. You can see back here the little bigger numbers. I had to put those on there myself because we usually don't get those calculated. And for a while back in August, it was like the daily pivot was becoming very important. Usually when we're above the daily pivot, that's positive. When we drop below it, that's more negative. You'll also see some other lines on here. And I don't use these as much, and I don't point them out in the videos, and there's a reason for that. Do you see these lines going sideways here? There's green and there's red. We got the Christmas thing going on here. Like Red Green, if you're into that show. I think he's hilarious. I like the prayer for men. I think that's so cool. Anyway, what this tries to measure is the volume that took place at a particular price level. And in theory, that sounds really cool. The green is when people were buying, the red is when people were selling. The problem that I have with this is these lines only calculate based on the volume going back to the beginning of this chart. So it may not be an accurate representation of the real volume taking place at different price levels. I still look at them, but I don't focus on, you notice I don't bring those up in the video. So I don't have a lot of confidence in these, but I still like to look at them anyway. And then there's another thing here. This is a volume weighted average. And when we're above this blue line and going up, that's more positive. When we drop below it, that's more negative. Very simple. Just acts like a regular moving average. And it's also based on volume. So we get some aspect of volume analysis in with this chart. But this is what I go through. This is what I look at the start of each video. And then this is a different representation of showing these volume levels, price by volume. That's what I'm trying to think of. And I go back as far as I can here. I go back about 3 years, and this is a better representation here. But you can see, is this really all that helpful? We see some really big lines right here, but okay, it might have been resistance at this point. But other times, there's times when we hit one of these points and the volume seems to be really low. I'm not a big believer in this, but maybe I need to study this some more and get a little bit more convinced that these can be helpful. Because in theory, it's a great idea. I just don't see it all that practical at this point. And then here, these are the pivot points. So we have them not only intraday, but this makes it look like the chart was hit by a machine gun here, because it keeps the previous pivot points. Believe it or not, previous pivot points can also become a source of support or resistance. I was seeing that a lot more back when the market was going sideways in 2013 to about 2016. I would draw lines at these pivot points, and it seemed like they were really influential during that time. They don't seem to be that influential now, but we might go back into a period where they do come back into play again. So again, I just like to keep an eye on those. And then this is the big one. If you look over on the right-hand side, this was the weekly chart, and this is when we topped out in July. This is a pivot point. It may be a little hard to see. I have it. No, this is about as much as I have here. I might have this chart later on. I can't remember. But we came right up to this level, and that's when we put in the high before we started to see things head south in August. And the cool thing is, this is on the chart before the price even got there. And so that can be a really useful tool. This is a chart that you're probably familiar with if you watch the daily videos. This is just a daily chart. I go back 2 years. I draw some different trend lines on here. I don't really focus on any patterns. There are pivot points here. I have previous highs, previous lows. I draw some lines to suggest that there may be some resistance. And this has been pretty accurate, a pretty good way of really trying to measure things. And so this has been kind of useful for determining when we may be getting to support or resistance as well. And then the Ichimoku cloud, I also call it the itchy and scratchy cloud. Really all this is a series of moving averages that are shifted forward. But a lot of people in the Forex markets use this, and they use it to determine if we're going to hit support or resistance. Chris Shavako, another video that I'd recommend that you watch each week. Some of what he says really wouldn't apply to us because he's more of a broader based, longer term money manager, but I've learned a lot from him, and he's got some good ideas. But then you watch him for a long period of time and you don't really pick up all that much. So it's just feast or famine. But anyway, the idea is when we're above the Ichimoku cloud and coming down, it may provide support. And so far, it looks like that's what's been happening. We came back down into this green area and we've been bouncing back up. If we can get above this green area, that's going to turn things even more positive. So this is just another area. And I may go months at a time and not show this chart in the daily videos because we're way far away from this cloud. I didn't start showing this until the latter part of August when we started heading lower. Because we were well above the cloud, so there really wasn't any reason to talk about this chart. And then this is one that I created for another reason that's kind of become interesting. I take a 20-period simple moving average of the open, high, low, and the close, and that's what these 4 lines are on here. And believe it or not, sometimes when we're going down and we go back up, that can act as one of these lines may act as resistance. And when we're going up and we fall back, sometimes one of these lines may act as support. And that's why I include this. And when we're above this little, I call it a mini rainbow, and we're turning back up, we're more positive. Well, we're starting to flatten out now after we had been coming down. The longer we can stay above this, the more improvement this little rainbow is going to have. But this is another source of potential support or resistance. And then we have our great moving average tree, which looks like spaghetti just spilled all over the place. Moving averages. And I plot, I don't have enough time to tell the story, but I have an interesting story that I'll mention in my class about what's the difference between a simple moving average and an exponential moving average. And a seminar that I went to one time where a guy I don't ask a lot of questions, but I did ask with what he was talking about, do you use simple or exponential moving averages? And I don't think the guy even knew what I was asking. I don't think he knew that there was a difference. And to try to save himself, he tried to insult me for asking that question. And I came back at him fierce because this ended up being one of those get rich quick guys that quickly went out of business. The guy ended up going to jail and it just turned into a terrible thing. But, you know, I go to some bad seminars sometimes too, just to see what I can pick up. But that's why I plot both of these, because there is a difference between the two. Now, we tend to focus on the simple moving averages. That's what most people use. And if you ever read John Murphy's technical analysis book, he basically wrote that book after the 87 crash and did an extensive research comparing simple moving averages with exponential moving averages. And because they move a little bit slower, and that tends to work to your favor, he suggests that simple moving averages are better than exponential moving averages. Exponential moving averages do move faster. And so that means people are acting quicker. And sometimes that's not the right thing to do. I plot both of them because it's like, okay, which one do I like? Both. We want to look at everything we can to get some information here. And these can act as resistance or support at any given time. This is a chart that you may be familiar with. We're kind of dealing with this right now, where I drew a low from the October 2022 low and then just extended that forward after we hit the March 2023 low. And then we just kept going up. So I drew another trend line from the March 2023 low up to the May 2023 low and kept that going. And then we were still going up, just screaming higher. So I drew a low from the May 2023 low all the way up to this low right here, which was the July 2023 low. And that just means when you see these short trend lines like this, we're just screaming to the upside at that point. Well, we fell back below that. This did not provide support. Then we came down here and we broke below this support level. And then I was pointing this out in the videos. Are we going to come back down to this? We could have still done that, and we still might. We don't know what's going to happen here. But as long as we hold this support level, the longer-term uptrend is still intact at that point. People are going to be screaming for blood if we start going down to this level. They're going to switch over bears. You're going to see headlines talking about doom and gloom. The perma bears are just going to be having a party. But as long as we stay above this level, this longer term trend line going back to the October 2022 low, that's still in force at that point. We could still maintain a positive stance longer term. And that's going to be brutal if we fall. And it looks like we might not, but there's also a chance that we might fall to that level. And then this is the NASDAQ 100 where we were coming back up to the previous all-time high. I had this on here before we even hit this level. And I posted this one on Twitter. Is this going to cause a problem? And it did. This line was there before we even got there. And we fell back. We came back up again, fell back. Then we were able to break through it. Then we hit a daily pivot level. That acted as overhead resistance. Then we came back down. We tried to find some support at the previous high, broke down below that, tried to do a false breakout back up, and then we came down and look at where we found a bottom at a daily pivot point. You see how this all kind of fits together and how we can use this as part of the same overall puzzle. And now we're breaking out again. We still have some overhead resistance, but last week, a lot of good things happened in the market where we were able to get above this. We just want to see, can that continue in the upcoming week? And then we also watch the Fibonacci levels. This is the one part that's kind of related to Elliott Wave that I do follow, where I just go from the all-time high, and right now we're watching it on the NASDAQ. The other ones aren't really in play right now. The all-time high, and then we came down to the October low, and then we just draw these different percent retracement levels, and you see how these really come into play at times. And these lines are on here before price even gets here. So we can know these things ahead of time. We came right back down to this 50% retracement level and bounced up off of that. And we've been breaking above this other fib level. Can we stay above that and keep going up and get back up in here to what I call no man's land? All right. And then on the weekly video, this is a longer term look going back to 2009, where we just have a trend channel. And then we have a midpoint of that trend channel. When we're above this point, that's acting as support. If we really start to go up, this upper line may act as resistance. We came down here, and this acted as support when we hit the COVID low. So this gives you a longer term perspective. And then this was the chart I was referring to, where we hit, and I'm sorry, I just wanted to look at the clock. I've got about 6 minutes here. Where we came up to this R1 level, and I pointed it out at the time. Maybe I should have stressed it a little harder, but I saw what was happening here. We came right up to this point, and then this is the downward move that we've seen throughout the month of August. Doesn't look like all that much longer term, but if you got in right here, you think life sucks right now, and you're really hoping that we're going to come back up. And if we do, we're going to want to be able to break above this level for things to turn back more positive, and we may come back up to this point again, and that may act as resistance again. Because you can see other times when we hit these levels, it's like the market didn't even pay attention to this. But we came up to this one this time, and the market did pay attention to it. So that's part of the variables that we have to play with every day. All right. And then this is another chart that I show quite often. We're not really in any danger here on this chart right now, where this is a very long-term chart. This is a weekly chart of the S&P. This green line at the bottom, that's a 200-week moving average. I mean, that goes way back. But we came down and tested that in October of 2022. We fell below that, came down to this 50% retracement. That acted as support. We were able to get back above. This was the line in the sand between a secular bull market. As long as we stay above this green line, in my opinion, we're in a secular bull market. That means decades. That's long, long term. Everybody else is saying bear market, secular bear market. My definition may differ from other people. If we had come down and really broke below this green line, we would have switched from a secular bull market, which we've been in since 2009, over to a secular bear market. We didn't fall that far. We were saved. It looked like we were getting pretty close. And I was really watching things as this was unfolding, but we were able to come up off of that. So longer term, and you might have very long-term investments, maybe some mutual funds, index mutual funds, that you get into based on this. that you stay in for decades at a time. So there's some long-term strategies that you can get in that you maybe only make a decision every 5 to 10 years. You might be adding to it maybe every month and doing some dollar cost averaging. But if we had really broken below this and switched over, then you might have to get out of those for a while. So, and some of you that are in 401ks, retirement plans, you might base a lot of your decisions on this because you can't move things as quick. You only can move it during different time. The one that I was in is like, was it twice a year, 4 times a year, once a quarter, something like that, when you can shift from one to the other. Anyway, all right, that's all the stuff that I had to go through here, folks. And my goodness, I'm just about on time. Woo! Oh my. I love doing this. I'm exhausted, but at the same time, I'm stoked because this is what I love to do.